Are you messing with me?
From a trading standpoint, no, it's been great. I mean,
Yeah.
what we've gotten is good markets at, again, the fall from 115 to 111 in euro. It's a big move.
Geez, right into it, wasting no time.
But the bounce back is equally impressive. We are still getting, what is nice is we're getting big ranges, and I like that. So, and I think you've actually done, for those who don't know, Frank's actually got an advanced math degree. So while he looks just like a cutting edge,
They know. I've told everybody.
model, he actually,
A lot of 5'6" male models running around these days.
yeah, with
5'7"
set
on
of knowing how
Sundays.
to skin a popossum or other small animals that he learned at Michigan State, at University.
Didn't go to
God
Michigan
forbid,
State.
God
Didn't
forbid.
go to
That's-
Michigan State.
I know that's like saying you freaking spent time with Osama bin Laden.
Plenty of respect for Michigan
Oh,
State.
yeah. But this idea of unique price points, the bigger the range, it seems it's obvious, but it's not. The bigger the range, unique price points with a product that scales in terms of size. In other words, I could trade little bits that can become a bigger position, but the availability to, rather than just say, I've got to pick one level, and this is where I'm getting in, but to work smaller pieces around a level, because there's so much elasticity, it's very powerful for a trader.
It is pretty crazy. We have done a lot of research over the years on every market under the sun, it seems. And my infatuation, has always been, at the end of the day, coming down to how many price points have been covered. Like volatility is a measure of how much distance a market has covered. Realized volatility is that measure. Implied volatility, a measure of how much distance they think the market can cover in the future. Standard deviations, measuring how much distance has this market covered in a given day, a given week, a given hour, whatever kind of time frame you want to assign. And you're absolutely right. I mean, just look at, you don't have to be a mathematician to understand it took from October until January to go from, let's just call it above 110 down to close to 102. So let's just say about 800 points to 1,000 points. Okay, it takes 4 or 5 months. Here in the start of this year, we have done that in about half the time, and then actually built on another 20, 30% of unique price points in a 3 or 4 month period. That's a lot of action. And now you're seeing what's really underrated is the last couple of weeks, Pete, to your point. It's one thing to cover a lot of distance in one direction. That can be very, very interesting. And then it can turn very, very monotonous and the most difficult trade in one direction. Even a lot of times if it's going in your favor, if you're long euros down here at 104, they skyrocket to 106, you sell some. They skyrocket to 108, you sell some more. And then now they're 110 bid. And all of this action, what can you do?
You know what? God bless you. You nailed the bottom.
Sure.
You took half off on a 2 standard deviation move. You took the other half off. You never go back and look at that trade. Oh, if I only held on to that. And I think that's a hard thing for people to do. Well, I got out of my winners at 108, so I can't buy them until they get back to 107.50. Compartmentalize. Take that win. Congratulations to you. You did it perfectly. Now look at what the market's providing for you. And you've got to balance your memory around, well, I sold 107.50s. I can't buy 108s. If you bought at 108s now, it would have been the best trade you ever did. You've got to get that emotional aspect out of your mind and take the fact of, because if you were buying 102s and 103s, again, every headline was, how quickly are we going to get to par in Europe?
Sure.
You were definitely contra-trending against an aggressive trend. Well done. You used math, you used stats in your favor, which talked about the extremes, and you profited from that. Compartmentalize that, move on to the next available set of price points.
Well, and the whole point is, I think if you're not trading, but you're looking at prices on a chart and theorizing about trading, you might think that these couple of days were the most interesting days on the chart. And you and I,
They absolutely weren't.
I mean, you run one of the 5 RFEDs in the U.S.
Right.
A lot of data that you can look through we publish a lot of data, client sentiment, all these different things that you can look at, but there's also a lot of data that can tell you how interesting was this actually for traders out there. And these weren't the most interesting days. These days breaking out of these ranges and these days that we're starting to get back into new ranges now to the downside are the most interesting days. Because my point is, if you're long going into this move, you're probably not long up here. And if you're starting to get short into some of these moves, at this point, it starts to become like, okay, what else can I do here? And now you're starting to see so much two-sided action. Right. The fact that this week alone, we've seen a move from above 112 all the way to, I mean, you and I were talking on Monday, and we were thinking, man, is 109.50 the next move? Right. Nope, bounce back, now 112 bid. Huge moves in both directions, which at the end of the day is a lot more. I'll take 3 days of 70 to 80 point moves in either direction in euro dollar
200 point
versus 200 point days in the same direction, which is what we had for a couple of weeks here to end April, which was really the least interesting part of the year so far. So I couldn't agree with you more that, it's one thing to measure distance. Obviously, this is a more high vol environment than it was last year. But right now, in May, we're starting to get what I think is one of the best environments where you're pairing, yes, volatility, big moves. I mean, the moves that we're seeing here in May, are they this move in April or this move in April? No, they're not that big, but they're in both directions. Right. And that's where you really, to your point, you can be long, short, sideways, all these different things in a matter of a week. Right. Where here, this move, you were either long and then you were short, or you were long the whole time. Good for you. But there wasn't a lot to do around that. Where here, I mean, and we're talking about Forex, and we're going to get into a segment here in a second. But you even think about other markets that you're trading. It's a similar environment where you might have options, you might have all these things going on. Two-sided action lets you take some of this off, put some of this on. Same thing here when you look at all the pairs and you're thinking, okay, maybe I had some, euro sterling on. Euro's starting to bounce a little bit. I could take some of that off. Right. Oh, I can now get some more dollar longs on that I missed a couple of weeks ago before this move in May. Right. I could put those on. Maybe those are starting to hurt a little bit in this move here this morning. But you're able to do so many more things in this high vol two-sided market. And yeah, I hope that people, in whatever way, take advantage of this, just because it doesn't happen very often where you have a lot of volatility and two sides. I'm not even speaking necessarily just to Forex, but you have NASDAQ in the last month, how many days of 300, 400 points in both directions at this point?
And that's really hard not to get your face ripped off on one.
Yeah.
And I think you've got to let yourself off the hook a little bit. You can't have an opinion on like right now on euro, I don't have an opinion.
Sure.
Now, I'll trade both sides depending on which way it moves, but you're not compelled, because I trade euro, I always have to have a bullish or bearish bias. You don't have to. What's great with what we offer is you've got a lot of different product choices within the world of FX. You can, that Aussie chart looks very different than that euro chart in terms of a pullback. Do we get a pullback? Yeah, but we're right back to highs in Aussie. Kiwi right back close to 60 cents again.
Big move.
Different kinds of moves. And, I think that the ability to have a kind of, bias that fits your trading style is great. You don't always have to have one. So like on that example you said, you caught the up move, you managed some, that's great. You managed the balance. You didn't sell the end of that big green candle.
Would be if anyone out there bought 102s and sold 114s.
And you're doing that part-time as you're curing cancer with the other part of your brain. you sold somewhere in that green candle, probably the bottom half of it. That was a great day. That's
Great
a
trade.
day where you're done.
Yeah.
You know what? It's one-way action. You're going to take a really nice gain off the table and look at other markets.
But I couldn't agree with you more that if anyone's looking
This is where it gets interesting.
if anyone's looking at this action and I have to shout this guy out, we love him, and he'll probably start to, hopefully, I hope he starts being on the show in the near future. But you can't have the Twitter Mike mentality with some of this stuff, which is
you got to have the Twitter Mike. You got to have the
he's
Twitter Mike story.
He's way smarter than me, knows way more than I do on so much stuff. But we joke about Palantir, the stock that now is like 130. It climbs $5 every day. I don't understand it. I think he's the one who told me that you might want to look at the stock a couple of years ago. I have some shares, thankfully. It's been crazy. But his joke is kind of like, oh, yeah, I would love to buy that stock below $30. Right. And it's like, Mike, I don't know if you're getting $30 again because it's trading 130, and every time they try to sell it off, it's only getting back down to like 90, 85, and then it's bouncing back.
Right.
A similar thing here, where if you're looking at this move, I mean, here in the last 5 to 10 trading days, you have a 300-point move. We're trading 130 half. We get all the way down to 110 half. And that's a huge move that if you're going to trade both sides or you were looking to get long Eurodollar in, that's a really interesting move from a mathematical standpoint. Is it 104s or 102s? Absolutely not. But you get the feeling here that all tariff talks aside, anything that's been going on here, and if you watch the show, I don't really read the news, it's going to be hard for this market to get back down to 102. And it's going to be hard for it to do that just judging by historical price action. It's going to take at least a couple months to get down to 102 if it's going to even do that.
Right.
And so if you're taking any longs off the table in your strategy in a market like this, or shorts off of the dollar yen table, whatever the market is, because it's not at that price extreme that I saw at the end of 2024.
Pull this out to an hourly, will you, Frankie?
It's going to be a tough trade the next couple of months. But yeah,
because we talked
these are
about
huge moves.
We talked about that 112 level and how it held in so well until it didn't. Now, if you bought 112.10s, 112.05s, that worked for you a couple of times, a little bit. If you're trading the one standard deviation range, that's around 38, 40 pips. If you had bought the 112s, you'd be thinking like, well, I'm doing pretty well. I'm up 22 pips on them. Yeah, you took a 120 pip loser.
A lot of heat, yeah.
This is why we talk about symmetrical risk management in static delta trades, which is what this is. Again, there's no premium, there's no anything. It's if you're long, goes up, you make money. If it goes down, it's simple product construction. Here would have been a case where if you were long at 112 and made that decision about where am I wrong, where am I right, you didn't get the 112.50 to print to get out, but you probably should have been managing on 111.60. Now you could argue, well, if I sold 111.60s and 111 halves, I wouldn't be long. Yes, but you would have avoided 80 points of pain to the downside. And you could have re-looked at the market again at another point.
Well, it opens up all of this, and all of this is 24 hours of trading. Like this isn't all. This is a huge move in one bar.
We don't talk about management just because. Again, you can go anywhere and read 1,000 descriptions of what a stop is, whether it's a stop, whatever. It is looking at being able to stay non-denominational around a market, which I mean is I can only be long because I've invested so much money being long. God forbid if I go short, the market's going to rally and I'm going to want to kill myself. I've seen guys do this.
Hopefully not the last thing. Hopefully.
No, but I've seen guys trap themselves in, I can't trade the one side of the market that's working because I've lost so much money on the other side.
Yeah.
I've probably traded a couple hundred SPOOs in the last couple of days.
Brag.
No, it's not a brag. It's the fact that I couldn't tell you what.
Yeah, how many were long and short?
I couldn't tell you.
Well, and at the end of the day,
that is a concept of none of the losses were too big, none of the gains were too big. They were managed, and I moved on. You don't want to keep a long memory with this. The market can emotionally stick you with memory. That prohibits you from making.
Well, and
we'll move on from this topic, but that stickiness of memory prevents you from taking advantage of markets in both directions.
well, and if there's one thing that math and historical data has proven, it's that markets are not memory full. They're memoryless. Almost. Oh, if you ever get in your head of, I mean, you just made the point where we'll get to it in a second. But it's like, oh man, like 112, they can't break 112. Look, they bounced off of it to end last week. They bounced off of it to start this week. And then they absolutely annihilated it and didn't look back for, like I say, more than 24 hours. The last thing that you wanted to, I mean, you do whatever you want. The last thing that you and I do is read the news and then form an opinion and then be like, man, yeah, like I think so-and-so about these tariffs, so there's no way I'm buying SPOOs.
Right.
Or there's no way that I'm long in this dollar at any point. I can't possibly sell this euro dollar. The dollar's going to dust because of all these different things. The market doesn't care about any of those opinions or any of those news points because it digests them. If you go back to Sunday night, Monday morning, it digests what the news is way quicker than you do.
Right.
And it's way more efficient and understands all sides of the news because there's thousands, if not tens of thousands of people that are digesting that news faster and entering in their orders in these markets. So you can't have a memory for those
I've heard
things.
that. Well, those algorithmic tape readers, they're bad. They move faster than I do. No, they add elasticity to the market. They give you opportunity to get in.
They let you do things that you couldn't do 20 years ago.
Here.
That's for sure.
Hey, if they want to drive stuff on a news event, let them act. That's not our game, is to interpret headline tweets and then take action.
Our game is you look at the big standard, outside the standard deviation move this week, and we're all the way back to unchanged on the week. It's a great move. Let's get into the segment here very, very quickly, and we're going to rip through it. It's actually going to be a fun one. I don't mean actually in a bad way. They're always fun.
Now, is this
but if we can move
summer
over,
dishes of
perfect.
squirrel and possum?
This is not. It's not a food show. Is the Head and Shoulders pattern for real? I have my friend Pete on. He's already laughing. He's not a technical analyst by any means, although you weirdly do like some technical analysis tools. Sometimes you'll be like, oh, this moving average just crossed this one, so like we'll see what happens to SPOOs here.
I read this. It's called a Certified Market Technician. It's a book that gives you all the patterns and stuff like that. A guy named Perry Kaufman
Sounds
wrote a book.
very dated right now. I'm going to be honest with you.
A guy named Perry Kaufman wrote a book years ago about technical analysis that, if you're interested, read it.
I'm sure it's interesting.
Yeah, and I think technical analysis is great because it lets people who may not have the experience to keep all those price levels in their head, visualize the market. When you turn over your decision making, when you hand the mouse to the line or the Head and Shoulder, that's the problem. That's what you don't want to do. You'd never want to hand over decision making to the line. Well, the line says we should be back here.
That's an interesting way to read it. At the end of the day, technical analysis, like the Head and Shoulders pattern that we're going to get into here in a second, though experienced traders like Pete might have some opinions about it now after, 40 years of trading?
He would be like, this is idiotic.
But it is it's a place to start. So many people get so paralyzed by oh man, I can't start investing in stocks because I have no clue where to start. Like, what should I buy? And it's just buy the, I don't know how many times I've told people, you can just buy the S&P 500. That's a place to start. With trading, if you want to actively trade Forex or whatever markets you might be lending technical analysis to, that's a good point. It gives you a starting place for okay, this is why I would look at. So many people are like, what would happen that I would ever think about being short any market? And this is actually an example of that exactly. Not saying that oh man, you should always be short, but it's an opportunity to get started and then learn, and then you can start to form opinions around, do I care about this Head and Shoulders pattern thing? Is it real? Is it something I want to use in the future? And you're off and running. But the Head and Shoulders pattern, Pete, is one of the most popular patterns in technical analysis. It attempts to predict a change from bullish price action to bearish price action. And a lot of these technical
Or
analysis
inversely,
tools,
there's an inverse head and shoulders, same thing to the upside.
of course, and a lot of these patterns or tools, RSI being below 30% or above 70%, they are trying to give you an idea of like, okay, this market might be too expensive or this market might be too cheap. Essentially saying it might be reversing direction. Maybe it already has. The head and shoulders is kind of a potential. I have to say that none of this stuff, of course, is guaranteed. The price action in the future is going to be what it's going to be, but it's trying to confirm that this market has gone from going higher to now going lower, and it consists of a neckline, which is what you see here, this horizontal line that starts from where it started its bullish pattern, where it kind of confirmed a bullish pattern, and then where it started to drop off in that bullish pattern, and then where it broke through. Now, above that neckline are two shoulders here and a head, which at the end of the day is just, okay, it peaked, it came lower, it didn't fall through this neckline, and then it actually had a higher peak, it came lower, didn't fall through this neckline, and then it had a lower peak, and now it's moving through that neckline to the downside, and now we're in bearish territory. To Pete's point, there's inverse in the opposite direction, where of course you would just be looking at a shoulder being a low, the head being a lower low, and then the other shoulder being a higher low, and then confirming to the upside. We actually have right now, and maybe we'll track this the next week or so, a market that is showing the head and shoulders pattern in the Eurodollar market, huge market. In early April, Pete, this market traded all the way up to above 113, backed off a little bit for a couple of days in here from that high, traded all the way up above 115, which is a high in this market for the last couple of years, came lower, bounced back to where that neckline is around 113, 114, and now has since traded below this neckline. Now the idea becomes, is this real? Does this confirm a bearish pattern? Will this market continue now from where it is right now, trading around 112, back down to the middle of the last year's range? It'll be I think this is a great example for people to watch.
Yeah, absolutely. And again, expectations that 112 level, which was support, now becomes resistance to see if we could trade above it. From expectation standpoint, if you measure from the neckline to the top of the head, that should be your expectation for downside movement.
Gotcha.
Basis the manual.
And what's nice about this is you can draw these on here. I just wanted to throw this up. This is our friend Glenn was able to, I'm going to be honest with you, I couldn't figure it out. But it actually is, you're just going into the platform and clicking 7 times, which is essentially the start of the neckline, the first shoulder, the confirmation of that neckline, the head, the confirmation of the neckline again after that head, the second shoulder, and then where it's potentially breaking through that neckline. What's really interesting about this, Pete, okay, so you understand what it is, you know how to look for it and how to draw it using the tastyfx platform if you want. I'm sure other platforms have it as well. But this is a really interesting one because we can follow this in the Eurodollar market, huge market that's often quoted, often traded by so many people globally. But you love when the market's even. Like, we're not coming to you and saying, oh, Eurodollar's back to 105, and so obviously it was a head and shoulders. That's not really useful.
Right.
This is a market that got down below 111, is now trading 112 bid.
Right.
And so if you thought this head and shoulders was going to be confirmed, it has a nice 150-point bounce that you could sell into if you think it is going lower. If you think this is all BS, maybe we continue back higher to 113. I mean, the head and shoulders is, in my mind, proven wrong in this. If we get back to 114, 115 in that area,
exactly,
if it continues lower, true.
A breakthrough of the neckline breaks the confirmation of the head and shoulders, and you move on. So, yeah, I think what I see is people, you can take any chart, draw enough lines on it, and come up with a bearish cup and handle
50
and
different
a bullish
direction it's going to
flag
go, yeah.
on the same chart. And then it's like, okay, pick one. And then you get decision paralysis. I think all this is great because, again, there's a reason Tom hates this. Tom and people, I've got friends I've traded with 40 years. Tom trades 100 underlyings from a ribbon and bid-ask prices. Do I know
Doesn't
anyone
open the
else
chart very often.
Do I know anyone else who can do that? Absolutely not. He is truly a savant when he does that. So he can process all that. You know, he's our own crazy supercomputer with a beret.
I hope he's listening.
I hope he's not, because I will deny saying any of this. But for those of us who are mortal, visualization is an important part for context. So again, these are tools. These are tools to better reinforce your trading strategies. Used appropriately, they become productive parts of decision making. And that's the only comment I'm going to say. But yeah, this is technical analysis. I mean, I started doing point and figure charts before they had computers.
I'm sure.
I actually had graph paper and did them up and down.
It's a great way to start.
For a new guy who's trying to figure out what is a daily range, how does that work? Great tools to use. And they're all provided for you on the platform now, which is great. So use them effectively. This was a great discussion.
I can't say anything better than that. Great way to close it. Coming up next, you've got Tom, Tony, and Vanetta. Thanks for watching, everybody. Stay tuned.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastyfx. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastyfx. Download today.